Nancy, let's pick up where Mike just left off. You think it's a better bet for most people to stick with quality and not try to capture, those names that are going to be skyrocket? I mean, how could you, right? Like the difference, I guess, between trading versus finding good, solid investment opportunities in this market.
I think actually, Kelly, you can do a little bit of both. We have taken gains in some of our consumer staple stocks because, frankly, they've risen to about 6% of our portfolio. So Walmart, PepsiCo, and we've put those funds to work in things like Chipotle, which gives you some growth trajectory, but was attractive on our valuation discipline. So I think if you look carefully, you can. But yeah, indeed, you want to own the highest quality names in almost any environment, but particularly now. And that's what we happen to own in our portfolios: large cap, value-oriented companies that pay a growing dividend and have an above-market yield.
Sure. And on that note, Jerry, should investors in this market in general be concerned about more dividend cuts coming, more secondary offerings if companies need to raise capital?
Yeah, so you have a couple problems that you're trying to solve. Solvency and liquidity. The liquidity problem is still with us. The Fed has thrown the kitchen sink at it, and hopefully it gets solved, but it's not there yet. And you see companies that aren't able to raise funds because of that. The solvency question, though, is the one that company by company, and Chevron's announcement this morning was a great example. They don't want to get into that mess. They don't want to be in a position where they can't pay their dividend or they can't make good on their obligations. So you'll see companies go through this process now of we're not sure when the bottom comes in, and we have to do things to protect our balance sheet. The issue with that is time, right? So the entire market's come down to a level that we're clearly in a buy zone for most long-term investors. The question is, how long are we going to stay here? I mean, do we need to stay at these prices for the entire period of internment that all of us are in? Or will there be opportunities along the way? And I think that will be the time where you get to break down individual company balance sheets. Okay. And Nancy, I know you were also heartened at what Chevron said, that its dividend is safe for now.
Yeah.
McDonald's, Intel, again, reducing buybacks, but keeping the dividend safe. So do you think the worst is past in that regard?
Well, I don't know the answer to that. I will say this, though, Kelly. Our valuation methodologies give us a lot of information on the macro situation. So fourth quarter of last year, we were concerned about a correction. We went to our clients. We put a hedge on. That kept us clear-eyed in this period. We put the hedge on February 12th. We've renewed it. But now we're actually starting to think maybe now is the time to purchase calls on a long-dated basis to complement our long-only strategies. So we've been gingerly in buying things like Microsoft, Palo Alto Networks, Splunk, Salesforce, companies that we think are going to benefit coming out the other end. And so that goes back to your earlier question, can you actually get both? But we're also overweight healthcare. We're also overweight consumer discretionary. We were buying Starbucks. Now, when I say buying, I don't mean we were building a 5% position in one day. We're just adding 3 or 4 tenths around the edges with available cash and with the proceeds we get from selling out of the dogs. We exited Boeing. I mean, you say we got that 100% wrong, but when we were worried about the dividend, we got out. And then we redeploy that money to something that's more productive.
Sure. So, Jerry, final word on that. The hardest hit parts of this market include both the sectors, such as the airlines and Boeing, hurt by coronavirus, and also those like energy, which has its own problems, and financials because of low rates. Is that where investors should look for big upside, or should they stick with the kind of plays that Nancy is describing, maybe tech, where the selling pressure has been less intense?
Sure. I mean, here's the problem. All professional investors right now are trying to crowd into the safe trades. All those names that were just brought up and a lot of the names that are talked about right now are kind of the only places where actual fresh money's going. They're still the only thing that's going on on the buy side on these deep cyclicals and energy is short covering. Those are the names that, on the other hand, have gotten down 30, 40, 50, 60%. From our perspective, I think there is an opportunity to start looking at the better names in the beat-up industry. So, to me, Boeing gets more attractive here. For sure, Chevron and JP Morgan, these are names that are going to be more than around, and yet they're down significantly more than the safe trades. And from our sense, there's just not going to be a lot of sellers of those names down another 5 or 10%. And you certainly want something in your portfolio, right, that has the ability to bounce by more than 10 or 15. And if we're really going to come out of this, you're going to see a much sharper recovery. And on a risk-adjusted basis, there's room for that type of name. And that's why you want to look at it from a balanced perspective.
All right. So you bought the Boeing from Nancy.